Ash, your sound is off. Ash,
There we are.
there we are.
Think we got it fixed. Thank you, Jack. Very well said. It's Wednesday, July 14, 2021. This is the Real Vision Daily Briefing, where we now have live sound. I'm Ash Bennington, joined by Jack Farley, and today our guest, Darius Dale. Welcome, gentlemen.
Hey,
Great
what's
to
up,
be
Ash?
here, Ash.
It's a pleasure to be here with both of you. Let's go through the stories that we're looking at today, moving markets right now. Fed Chair Jerome Powell, is on the Hill testifying before Congress today, talking about inflation, the economy, and the jobs market. Jack?
Yeah, Ash, today the banks reported their earnings, and it really is a tale of two cities, with Wells Fargo up 4.21%. It's a huge amount up to be up in a single day, while Bank of America is down 2.51%. Persistent lagging loan demand, as well as a flattening yield curve, really are a thorn in the side of banks. But on the other side, you do have bank buybacks that are going to be really roaring up. So a lot to break in, which I look forward to doing with you and Darius. Ash, what else you got on your radar?
Well, let's hope that the Dickens metaphors end right there. Today, oil is down off 2-year highs, 2+ year highs, I should say, on rumors of a compromise between UAE, the United Arab Emirates, and OPEC. The rumor is that the new agreement will allow the UAE to pump more oil, greater output caps. That's the rumor, and oil is dropping on this news that potentially more supply will be hitting the market. Darius, we were talking a little bit off camera about some of the things that you're looking at today. What's on your dashboard? What are you looking at right now?
I think the number one thing that investors need to be responding to right now, at least formulating views on, is this divergence between the Fed's inflation mandate and their asymmetric inflation mandate, as they outlined last year at Jackson Hole, and their broad-based, inclusive maximum employment mandate. If you look at the sort of spread between those two mandates, it's probably never been as wide as it is now. You have headline CPI up over 5%. You have the total amount of people, particularly in affected industries around COVID, blue collar jobs, low wage workers, down about 5% off their highs in shortfall terms. So I think the Fed's in a conundrum, but ultimately we think that conundrum right now resolves itself in a way into the direction of more easy money.
Hey, Darius, let me ask you this. Did you get the sense, obviously, this dual mandate, always a challenge for the Fed, balancing two competing mandates, but did you get the sense that Jay Powell was leaning toward the dovish side in his testimony today? I felt like he was saying, well, potentially higher long-term inflation targets at this point, or inflation expectations at this point. We're going to run asymmetric, but he kept coming back to this idea that it was transitory, that it was limited in scope to a kind of rebound effect from the pandemic. How did you read that?
Yeah, and I think this is more like what we would likely to see at the July 27, 28 FOMC meeting. Recall, there's not going to be a dot plot revision, so it's going to be kind of the Jay Powell show, and you're going to have the Jay Powell show, senators sort of pressing him on inflation. And so I think he's got a chance to really try to control the narrative tomorrow to the extent that he can do so, but ultimately resolve that by the end of the month with just consistent dovish guidance. Obviously, this is the part of the movie where it gets interesting, right? Because we all knew this would happen, i.e., inflation would break out to the upside in this time period. Now, the reality is we as investors don't really have any idea or any real framework to decide, okay, what is transitory mean? What is it enough substantial further progress in the labor market means? We don't know. This is all brand new to us, and it's all brand new to the Fed as well. But ultimately, I think Jay Powell, being the adept buy-sider that he is, and oh, by the way, the guy's worth like $50 million from his days on the buy side. He's a pretty smart guy. I think he's going to ultimately resolve this with the fortitude that you need to look the whites of the eyes in inflation and say, not here, not today.
Jack, what part of the movie are we at for you?
Well, I don't know. Let's go back a few months, wind the clock back to when inflation was running hot, and when the inflation came out and it was running hot, it beat all expectations. Bank stocks would surge, yields would rise, energy stocks would surge. Long duration technology companies, your Teslas, your Zooms, they would plunge. Now we're at a time in the movie, Ash, where we see the exact same inflation beats that are remarkable, that blow past every single Bloomberg median estimate, but we get the exact opposite reverse price action. Now it's energy that's on the back foot. Financials are going down. The yield curve has flattened. And Darius, how do you explain sort of this act two And what do you see for Act 3? I'm taking Ash's metaphor of a movie. I'm going more to a play.
Yeah, no, I mean, look, it's in sequential terms. We went from a sustained period of what our models call reflation. That's obviously a broad-based rally, bond yields up, things of that nature, to a more narrow Goldilocks period whereby you had bond yields declining, but you're not seeing that reflected in equities and credit to the downside. You're actually seeing it reflected in index terms to the upside as that liquidity continues to filter through the system. I think what's happening underneath the surface with respect to the former sort of leaders in the former inflation regime, you think about basic materials down 8% off their highs, energy down 11% off its highs. Russell Value as a broader sort of index to capture a lot of that exposure, it's actually down 9% off its highs, whereas the S&P and NASDAQ are basically at all-time highs. And so I think in terms of the act of the movie, we're either about to go into a risk-off period, which we would characterize as deflation as the next most likely market regime in our framework, or this period of Goldilocks that we're currently in is likely to see a broadening of breadth as a function of a more delayed reaction function out of the Fed.
Yeah. Jack, screenplays have acts too. I can assure you of this. So let's talk a little bit about one of the protagonists in the screenplay today, which is Bank of America. So this is a really interesting story to me because it encapsulates many of the ideas that we're talking about here, and it brings them into a sort of specific relief in a very clear way. So Bank of America, the Wall Street Journal headline that I saw this morning when it first broke was Bank of America earnings double. And yet, worst performing stock in the S&P 500 this morning, Bank of America. So let's take a look at this. Let's walk through the numbers. Let's try and understand it, and let's talk it through. So first of all, Bank of America beat on earnings today. Earnings were $9.2 billion Q2 2021, up from Q2 2020, $3.53 billion, 2.6x higher, roughly a 160% increase. However, these are the interesting parts when you look at the internal dynamics of these numbers. It tells a different story, a more interesting story, a more nuanced story. $2.2 billion in loan loss reserves right now. This quarter, it was released. So this effectively is reserves that banks hold back for provisions for bad loans. When economic conditions improve, when they believe their loan book is less exposed to risk, they release those reserves back into earnings. So 30% of net income come from LLR, these loan loss reserves. This is the interesting part. Top line, revenue line, it's a miss. As you know, as we've talked about, Jack, on and off camera, to a certain extent, everyone kind of thinks through, massage is probably the polite word, their earnings expectations. They come in, everyone wants to come in on a beat. It's a loss on it is a miss on the top line here. On revenue. So this is really an interesting thing. Revenue down 4% year over year, meaning revenue declined effectively from the peak or the trough, I guess, on your perspective of this crisis. We have weak loan demand, low rates, and net income dropping 6% net income margins dropping 6% year over year. Darius, jump in. Tell us a little bit about that story, how some of those specific data points fit in to the broader perspective that you bring, that you think through in your grid.
Yeah, I mean, I don't want to get second and third order or fourth order response here, but I think what happened to the banks this week is a function of investors realizing, hey, this economy has not yet got back to stable footing. I mean, I think we can all look around and see that,
Right.
but I think certainly heading into earnings season, there was this sort of potential for a sigh of relief that, hey, at least in terms of corporate America, we're finally achieving this sort of substantial further progress that you would need to see stocks broadly push higher from there. And then in terms of the second order implications of what's happening to banks, this is why I believe you could actually see a broadening of the rally. Because the reality is there's still a lot of headway to make in the economy, as denoted by their loan growth statistics, as denoted by some of the other metrics that you highlighted. And so when you think about heading into the back half of the year, you could paint a very rosy Goldilocks scenario where the punch bowl is actually not being taken away, or at the bare minimum, the timing of the punch bowl being taken away is actually extended relative to market expectations, immediately following the June FOMC event. And then you can actually see, again, that broadening of a rally. Or the Fed does something very counter to my expectations at the end of the month or in Jackson Hole and says, "Hey, no, we're taking the punch bowl away. We're spooked about this inflation. Everything we said about broad-based inclusion in the labor market, yeah, no, we were just lying. Let's crash the market." I think the market is at a very unstable state right now, and what I mean by that, we run a dynamic factor model called our global Racco risk matrix, which allows us to identify the market regime according to 42 different macro market indicators. And right now, the total number of confirming signals is in the first decile of the historical backtest of the entire model, which means it's very highly vulnerable to a regime phase transition. So we need to escape this next few days, this next week or so, with a much more conviction from asset markets than we currently see from the perspective of that model. So I'm on high alert for a market regime transition, and investors watching the show should be as well.
Jack, I know this is something that you're thinking about as well from the macroeconomic perspective, but also from the earnings perspective from today's reporting banks. What are your thoughts?
Well, Ash, yeah, I'll go back to the banks, which is I think that loan demand is quite weak. The loan book of Bank of America, for example, is actually down year over year, and quarter over quarter it's flat, meaning it hasn't grown at all. So that's stagnating. I think that Stephen Van Meter and Travis Kimmel, the president of Real Vision, did a video today on our platform where they talked about how they think quantitative easing is actually decreasing the demand for loans. So that is an interesting point. But actually, before
Jack, it sounds like you just set up the clip.
Yeah. I guess we have to take a look at it now, don't we, Ash?
Let's take a look.
If you and I work in a bank and a boss comes in and says, "Hey, you guys need to, I got, $10 million. I need you guys to go lend it out and make us some money." And so we go, "Okay, great. We're going to go, we'll loan it out to the car dealerships. We'll call it a credit union special, or something like that." And we go out and we say, "We've got 6% money. In fact, we've got all the car loans at 6%. And we come back and we got our flyers made and our campaigns and we're all excited. And not one person walks in the bank to fill out an app. Now, what does that tell us? A rate's too high or too low? Tells us they're too high. Yep. And that's all the bond market is telling us right now. It said, look, all these things that you think are true are not true. And if you're not going to lower rates to spur lending growth, I'm going to do it for you.
So there it is, Jack. Want to give a little color on that?
Yeah, well, if Ash, instead of you and Travis and Steve going to car shop, it was you and me, I wouldn't know what to tell our boss. I'd say, hey, the people are simply not getting loans. And I imagine a lot of loan officers at banks, particularly Bank of America, are having that very same problem. But let's zoom out a little bit. Why?
Can I add one thing to that though?
Yeah.
Like we're all concerned about inflation, and I tweeted this morning. Nominal consumer incomes, if you index it to the February 2020 cycle peak in the labor market, are up about 9.5%. Whereas inflation is only up about 5%. It's been more. The consumer incomes on a real basis have doubled in terms of the rate of change or the growth rate since the start of the pandemic. So I think it makes a ton of sense why people don't need loans. They have a ton of money. Even on a real inflation adjusted basis, they have a ton of money. And that's evidenced by the savings rate being so elevated still.
Absolutely. That's completely right.
Yeah, great point. Go ahead, Jack. Jump back in.
Yeah, but Ash and Darius, what do you think of the theory that quantitative easing is the source of the lack of loan demand? Because it's sort of crowding out the need for people to borrow.
No, I think that would be very counter to how it actually works in real life. I mean, it certainly allows you to retire existing debt a lot easier in terms of its impact on interest rates and draining the liquidity premium from low interest rates. So I don't know that I agree with that.
Well, I'm not. I'd have to see the broader context. We just showed a clip that's about 45 seconds, and I think what he's saying is that the demand for loanable funds at the rate that it's being lent at is below the clearing rate, but that doesn't necessarily mean per se that quantitative easing is suppressing demand for loanable funds. It could be that the organic demand is just below where it is. So you could make the argument in theory that there's not enough quantitative easing. In other words, purely in that model, if rates were lower, you would get more borrowing.
Yeah, for sure. And Ash, by the way, I mean, you could make the case for the broader economy. I mean, we have a very two-speed labor market. white collar employment is, rock rolling. There's obviously the Atlanta Fed's wage tracker data would indicate that, wage growth and that segment of the economy is actually quite robust. It's obviously just a two-speed bifurcated world out there. And so, if more quantitative easing is obviously a broad-based sort of hammer type solution, when the reality is we probably need to start exploring more macroprudential measures and more fiscal policy measures to address some of these sort of inefficiencies in demand in the economy.
Well, that's exactly right, Darius. And by the way, let me just say, quick disclosure, I wasn't suggesting that I would advocate for pushing interest rates even lower. I was just saying within the model, I think that was the point that Stephen was making. But absolutely, we had been talking about this conversation with Jack, with Ed Harrison, with lots of other folks, and I would always say, when we jump on these shows and we talk about this, I always worry about people saying, I don't know, labor market looks pretty good. Business is great. Look, we're here on Zoom doing business. Well, guess what? There's a whole economy filled with folks who aren't working from Zoom, who are not, on a beach somewhere doing their jobs remotely. And it is absolutely a two-speed labor market. It is absolutely still a time when there are a lot of people experiencing a lot of pain from the hangover effects from this crisis. Jack, jump in.
Yeah, well, I want to go back to what Darius has his eye on in terms of the signals. What economic indicators do you have your finger on the pulse for, Darius, that you think are maybe not priced in most macro models? For example, the copper to gold ratio is one that is very popular. Yesterday, I spoke with Michael Guyett, who talks about the lumber to gold ratio. Maybe that's a little bit more niche. But what did you sort of have your eye on, Darius?
Yeah, so in terms of our process, we sort of separate church and state. There's market signals, there's economic signals. The economic signals inform our views on how the market signals might evolve, but they may or may not evolve the way that our projections indicate. So obviously, every model is forecast error. We're very honest about ours. So the thing that gets me again, as I mentioned earlier, the market signaling aspect of what we do at 42 Macro is about a sort of, there's as much uncertainty associated with that as there typically is around market regime phase transitions. Like going back to, these statistics don't really mean anything without a chart, but going back to June 8th, we had more or less double the amount of conviction across the 42 indicators in the global macro risk matrix and confirming reflation and/or Goldilocks as the dominant market regime. There's a tug of war there at the time.
Yeah, we actually can put that chart up.
Oh, awesome. You have it? Oh, great. Yeah, and now we've gotten down to the words basically about half the amount of conviction or i.e. confirming signals. So, quite frankly, it could be anything. Going back to last January, I wrote about this in my note this morning. It was the 10-year break even in the German boom yield in the model that sent the entire system into deflation on January 30th. If you overweighted something like the S&P or overweighted something like high yield credit, you would have not gotten the signal until late February. And so obviously, that's part of the point of why we use that dynamic factor model, because at any given point in time, at any interval, you can get a signal from something in the model that is actually extremely instructive to your portfolio construction at a particular junction.
Yeah, Darius, when I think of the sort of principal component analysis, which I assume must be integral to your process, I think of the traditional components of what drives price action in, let's say, the S&P 500. It's the dollar, it's high yield credit spreads, investment grade credit spreads, the price of oil, interest rates. Have there been any phase changes over, let's say, the past month where, oh, wow, hey, now oil is explaining twice as much price action as it was a month ago? Or I'm just making that up. But is there anything interesting that you see in your models when you wake up at 3:30 in the morning to post?
4:30. I'm not that crazy. So look, there's been a lot of neutrality struck first in the commodity market and the currency market. That going back to kind of early June and really following through post the FOMC meeting. And then you start to see some neutrality break into the equity market components of the model. You're looking at the VIX, Russell volatility, NASDAQ volatility index, things of that nature. And then recently, as of last week, high yield credit spreads and investment grade credit spreads are broken to neutral. So the neutral signals aren't contributing anything. They're just taking down the amount of conviction the model had in Goldilocks or Reflation, which are risk-on regimes, and making the probability of a risk-off regime, which we think will be deflation, commencing at some point in the second half of this year, making that probability go up as a function of a higher share of those total signals.
Hey, Darius, let me jump in here because we've got a question, and I want to kind of meld it with what you just said because it's a really important point. The question comes to us from Leo Quadruple Z, and the question is, what are your thoughts on yields in the next few months? But this gets into precisely the point that you were just making, this idea of moving potentially into a deflationary model as we look forward, moving to a risk-off deflationary model. How do you think about yields? How do you think about deflation? And how do you characterize in your own mind what some of those indicators are that could suggest that we may or may not be entering a deflationary period?
Well, we've already shifted to a disinflationary period with respect to bond yields, right? I mean, so going back to this first week of June, we had the 10-year TIPS yield breakdown. The second week of June, it was the 30-year Treasury yield, the 10-year Treasury yield, the 10-year JGB yield. The third week of June, we had the 10-year gilt yield, and then finally in the first half here in July, we had the 10-year Swiss yield and the 10-year German Bund yield. All these things broke down to bearish from the perspective of volatility, just a momentum signal.
Just so folks know who aren't following macro as closely as you are. So disinflation is a decrease in the rate of inflation, not outright deflation, but a slowing down of the rate of inflation.
Absolutely. Great catch there. And so the sovereign bond markets, not only just here in the U.S., but increasingly globally, are agreeing that inflation has peaked. At least, from a forward-looking perspective, the market participants are betting on inflation having peaked, and we're seeing that reflected in break-evens. We're obviously seeing that reflected across the commodity markets. Most commodities are down 5 to 10% off their highs, or at least. So I think that's certainly something to keep in mind.
That puts you in the Jay Powell transitory camp.
Look, we like to listen to the market here at 42 Macro. I certainly not smarter than the broader market. I'm definitely not smarter than those 42 indicators. So I definitely, and quite frankly, I've always been in the transitory camp. We knew inflation would peak around this time. Now, we did have forecasts there on the June CPI print. We did think it would actually decelerate very modestly. It did not. Obviously, it did not, according to a lot of investor models, because Bloomberg Consensus also thought it would decelerate as well. So the reality is there is some widening forecast there that has investors on edge and are quite nervous, which I would argue is contributing to a lot of the neutrality and uncertainty in our model, and I think in a lot of other investors' models at the current juncture.
Darius, what did you make of how the bond market reacted today with yields declining, I believe, after Powell spoke? What does that mean? Confidence in what does it mean?
Well, I think the bond market is telling you that this kind of risk to transition into something that's a lot less sanguine than Goldilocks is still on. And because I think we got, it wasn't just Powell today, we got the PPI report, which was hawkish. Obviously, we've gone through this period where we've received like data point after data point that were incrementally hawkish. And then ultimately we have to get to the retail sales, industrial production data, which actually might indicate a slowdown in the economy. Now, again, we're going to be growing above trend for basically the next 2 or 3 quarters. The reality is at some point, the deceleration, the peak rate of deceleration is likely to be rear view mirror. And that, in my opinion, could be ultimately a positive signal. But I think the market is still very concerned about a lot of these dynamics because, again, you have this, I talked about the Goldilocks scenario where, you could see a really broadening price appreciation across risk assets. But there's also a scenario where, man, the Fed is just really nervous about all this inflation. And oh, by the way, there's more forecast there in the July CPI and PPI reports, right? Like that's a risk. I mean, I would argue it's an increasing risk relative to what we all just experienced as economists and model builders in the last couple of days. So there's a chance like this thing could go any one way. And if investors, if viewers, if you're feeling confused out there, it's not you, it's everybody. So don't panic. Just patiently wait for more signals and confirmation that you need to do something different with your portfolios.
Hey, Darius, talking about looking at this as an economist, unpack that a little bit. I know you're playing a little bit of three-dimensional chess here. You're talking about the second derivative, the rate of the change in what's happening for growth. How do you think about it? How do you explain that big picture from the reopening? The rate of increase is now declining. Tell us a little bit about what that means.
Yeah, absolutely. So the growth rate itself is slowing. The growth rate is the first derivative. The change in the growth rate is the second derivative. And the point I was making is that the third derivative might actually go positive because it'll decelerate at a decelerating pace. I know that's a mouthful for TV, but the reality is that dynamic can be very positive for risk assets. At least it's historically been positive for risk assets, particularly after a correction. Now, we haven't really seen a broad-based correction, right? I mean, the stocks or the S&P and the NASDAQ are right around their highs. We've seen the correction in things like the Russell value, pure reflation plays, which tells me that a lot of the negativity that's been priced into there has the potential to recover itself over the next couple of months if the punch bowl stays where it is. But again, we're playing hot punch bowl right now. I mean, imagine playing musical chairs with a giant bowl of punch. Like that's what's happening to asset markets right now.
Listen, when
everything is so murky, how are you thinking about asset allocation? If you're very sure it's going to be deflation, you want to get into bonds, you want to get out of all the cyclical stocks, your materials. But when things, are you putting if you don't know what's going to be on the horizon, are you putting your eggs in different baskets?
Yeah, I think a lot of investors make the mistake of picking up and putting down eggs for no reason. Like you shouldn't reallocate if you don't have a new signal to reallocate, right? Like we haven't had a new signal to reallocate, so we have not been reallocating. The only changes we've made in our portfolio construction at 42 Macro in the past couple of months have been reallocating away from pure commodity exposures and back into some more digital economy exposures and fixed income exposures. Again, I made this point earlier today. I'm pretty sure I was the first bond bear to go become a bond bull this year, at least in this investment cycle. So I'm proud of that. But that's kind of the points we've been making. It's about what you do at the margin based on changing data. And I would argue this is a particular juncture to not do a whole heck of a lot at the margin because we don't have signals that are pushing you in one way or another. When the signals push us into deflation, guess what? We're going to go full board deflation. We're just not there yet.
Beyond three derivatives, my brain starts to melt. I'm going to have to pull in Max.
Same here, Ash.
I'm going to have to pull in Max Wheathy to handle the snap, crackle, pop of the rate of change. Here's one that comes to a slightly different context, but all part of the same broader question. It's from Adavan, and the question for Darius is, will the USD strengthen if inflation tops in June? He's obviously talking about US dollar inflation.
Yeah, the probability of that goes higher. The back test, when you look at when the economy is in a period where growth and inflation are trending lower, you typically have dollar strength. In fact, that setup, that grid regime setup, is the most positive setup for the dollar. So it's likely that the dollar is certainly put at its bottom, and you could actually see some further price appreciation from here.
Yeah,
I've got a question for you, Darius, which is that if you look, and by the way, this is informed by Roger Hurst's video on the Real Vision Pro tier. For Real Vision, but where typically dollar weakness is associated with a boom in emerging market equities, but we really didn't have that at the beginning of the year. So what do you make of how a rising, if a falling dollar wouldn't boost emerging market equities, do you think that a rising dollar would not be a wrecking ball for emerging market equities like it traditionally has?
No, I still think, we're not calling for massive dollar strength here or appreciation here. So I don't know that wrecking ball is the characterization that I would use, to be fair. But yeah, no, I mean, the reality is EM just didn't participate in the growth recovery dynamic that the developed world got to experience as a function of their vaccination programs. So that likely means that they're still likely to actually participate at some point on the lag. The problem with them participating, and this is always the problem with emerging markets, they're so reliant on dollar-denominated credit to expand their economies. And so whenever you see the dollar tightening, it tightens the supply and demand, or it tightens the supply and cost of capital for those borrowers incrementally at the margins. So I think it'll just make it a tougher slog. You're trying to get out of this mud hole with vaccination programs and getting COVID under control. But at the same time, if you have the dollar at the bare minimum just not going down and grinding higher throughout that period, it makes that whole recovery process a lot more difficult.
Darius, you'll have to pardon Jack. He's a huge Miley Cyrus fan.
Who is it?
Here's a great question that comes to us from Maura, and a question that I alluded to the last time we were chatting on Monday. And the question is this: how does sector leadership change as you transition from reflation to Goldilocks? What sectors stand to see inflows and which sectors stand to see outflows? Great question.
Excellent question. Great question. So it's not necessarily just the change in the sectors. It's also the starting positioning. And I highlighted this 6 weeks ago in my notes saying, hey, look, if we transition to Goldilocks, people don't own digital economy exposures at this point, or at least not to the degree that they would need to participate in Goldilocks and outperform in that particular regime. And lo and behold, 6 weeks later, it's been the only thing in the stock market that's worked, because you can certainly see those flows when you adjust for performance on volatility adjusted basis. I like to think that Sharpe ratios, Sortino ratios are very indicative of flows, and they tend to sort of lead flows data, which obviously reported on the lag. So, yeah. And so you've seen the investors crowd into those exposures. And I think part of it is yes, we transition to Goldilocks, but also there is a actual and outright fear of deflation, ironically, as a function of having too much inflation in the Fed's delayed reaation function to that.
Good
So,
news is
so what's
bad news is good news.
Darius? If a reflation, you want to own energy and financials, maybe in Goldilocks, what do you want to own?
Everything. And this is my point. If we stay in Goldilocks, a lot of the stuff that's taken a beating will recover. A lot of that stuff had to take a beating because, again, we needed to, investors were overweight reflation, pure reflation. They were extremely underweight digital economy, Goldilocks type exposure. So we saw the market change hands a bit over the past couple of months, really not a couple of months, really since, over the last month since the June FOMC meeting, that's accelerated. If we stay in Goldilocks, a lot of that stuff will recover and we'll see a more broadening of the rally. But again, that's a big if. I'm not ready to make the call if we're going to stay on Goldilocks. I think fundamentally there's a large probability that we should, based on my interpretation of the Fed's dual mandate. But that's only my interpretation. I'm a thick-skulled football player. I could be very wrong on that. So ultimately, I'm going to rely on the signal to get me out of it.
One of my favorite quotes from Lakshman Akutan is, "Don't predict the predictors." Gentlemen,
yes.
Once again, a great conversation, truly. Jack, final thoughts, then we'll leave Darius with the last word.
Let's see. I want to, if I can sort of cue Darius up. So Mora asked, what assets do you want to own in Goldilocks? My question is, what assets do you want to own if the other one comes? Deflation.
Deflation, yeah. Oh, I mean, you're going to want to take whatever allocation of fixed income you have right now and turn it on its head relative to equities. That's the number one thing you should do. Obviously, you should consider raising cash, but if you have to stay fully invested, you want to be talking about defensive, mega cap, low beta type exposures. It's really a style factor trade. I'm much less concerned about sectors when we go into full risk off mode. It's about safety. It's about companies and businesses that have low volatility earning streams, low volatility cash flow streams, and usually those are the largest companies in the index.
So it's not so much about sectors, get out of energy, get into the FANG stocks. It's more about asset allocate. It's
yeah. It's step one is asset allocation. Step two is portfolio construction. Your equity exposure could be full of high beta cyclicals, or the same high of equity exposure could be full of low beta defensives. It's that portfolio construction pivot as well. So that's all the stuff we coach investors on at 42 Macro. Obviously, we like to have the conversation with you guys, but the reality is if you want the nuts and bolts, you got to go to the source.
And I'll throw in one more. What about the reflation grid?
Say that again. What do you mean?
What about the reflation? Yeah.
If we transition back to reflation, whoa, that would be a doozy, because that means a lot of investors who made money on the long side of bonds, as we have, are likely to start to get hurt, and that would really catalyze a massive outperformance of rest of world geographies relative to the U.S. from this point forward, because it probably means the dollar will finally break 90 on a DXY or something like that.
Well, perfect way to end it. Thank you both for joining us.
Thank you.
Wonderful, Ash.
Yeah, appreciate it. Thank you, guys.
Thanks for watching, everyone. Thanks for your participation. Thanks for your questions. We'll see you soon.